Welcome to TaxLawGH and welcome to our video where we continue the discussion on withholding taxes. Let's continue and look at still on withholding from the supply of goods, service fees, and contract payment. Remember we said so far that when you make a payment for the supply of goods and it is to a resident person, you withhold tax at 3%. When you make a supply of works to a resident person, you withhold at 5%. And a supply of services to a resident person, you withhold at 7.5%. Remember, there was a general threshold of 2,000 Ghana cedis that had to be looked at. So let's continue from there. We are saying that the minister can prescribe by way of making regulations that a resident person withhold tax when they are making payments to a non-resident person in respect of telecommunication services and transportation services, as long as they are sourced in Ghana. We'll look at that very soon. And also prescribe the rate of tax. We'll see that in the table when we get there. We are saying that everything we've done so far does not apply to a payment subject to withholding by an employer or a payment that is an exempt amount. We've said this already, that when you are making payment for an amount or to a person who is exempt from income tax, then you don't need to withhold, and employers have their own mechanism of withholding when it comes to employees. Remember this. Then we are saying that a resident person is also required to withhold tax when that person makes payment to a non-resident person for rendering management and technical service fees or management and technical services. So when you make payment, you also need to withhold tax. And also, a resident person is required to withhold tax from a payment made under a contract with a non-resident person for the supply of goods or works or the supply of any services where the contract gives rise to income from Ghana. There's a key requirement to know here. We are saying where the above requirements relating to contracts for goods, works, or services with a non-resident person applies, the resident person is required to, within 30 days of the date of entering into the contract, give notice to the Commissioner General in writing, telling him a number of things. This is one thing that examiners love to pick on. What I'm saying here is where you enter into a contract with a non-resident person, within 30 days of entering into that contract, generally you are required to write to the Commissioner General and give him details of the contract. And some details are the nature of the contract, the likely duration of the contract, the name and postal address of the non-resident person to whom you'll be making payments under the contract, and the total sum estimated to be payable under the contract to the non-resident person. We are saying that above requirements relating to contracts for goods, works, or services with a non-resident person does not apply to other payments which are subject to final withholding taxes to non-residents under the Income Tax Act. So the general principle is where you are making payments to a non-resident person who anyways have a final withholding tax, you do not need to notify the Commissioner General of these details. Once again, let me quickly explain the difference between final withholding tax and withholding on account, which I'm sure you'd have heard so many times. Like I've said countless times in the past videos, a final withholding tax, all things being equal, fully satisfies the tax liability of the person at the time the withholding is made. Common example, dividend. If you hold shares in a company and the company pays you dividend, or the company declares dividend and pays you dividend, the company will withhold dividend withholding at the rate of 8%. That 8% withholding is a final tax. What it means is after they withhold that 8%, you do not owe any further tax liability on that dividend amount. It means you can just receive your dividend and go and spend the money, do what you want to do with it, without accounting for that dividend in your personal income tax returns, which you are required to file 4 months after the year has ended. It means once you receive a final withholding payment, you don't have any other tax obligation with respect to that amount. Another example is, let's say you are an invigilator, or you are an examiner, or you're a part-time teacher or a part-time lecturer. The law requires the person who makes payment to you to withhold at 10%. That payment is also a final tax. So if you're a part-time teacher, you've received your money less withholding tax, you are done. You don't owe the GRA any further obligation with respect to that part-time teaching income you earned. So for final or amounts that are subject to final withholding tax, your tax obligation ends after the person withholds. You don't owe the GRA anything. Now let's come to the other side of the table, which people generally call withholding on account. These are non-final withholding taxes. A typical example is the example I gave you for goods, works, and services. The 3%, 5%, and 7.5%. They are not final taxes. So if a company enters into a contract with another company for the supply of goods, and remember that if the goods constitute trading stock of both of them, what will happen? There will be no withholding. But let's say this is a company, that's a service company, that enters into contract with a company that deals in goods. So after company B sells goods to company A will withhold tax at 3%. Now that 3% tax is not a final tax for company B. What company B has to do is company B will fully declare all sales they made during the year and go through the normal process of determining chargeable income from a business, apply the corporate income tax rate, get their tax payable for the year. Don't forget they will include the amount of goods they sold or the income from the goods they sold to company A. They'll add all of that in determining their income. And then after getting their tax liability, remember I told you that when A withholds from B, A will then have to issue a certificate or a proof or a withholding tax credit certificate to company B that shows that indeed A has withheld on making payment to B. So B will take that certificate, and then whatever amount he already paid in advance on that certificate, he will then reduce his tax payable by that amount before making any payments to the GRA. So remember that taxes on account are not final. That income on which it was withheld will still have to be included in determining your income for the year, go through the whole process of arriving at your chargeable income, apply your relevant tax rate, get the taxable, the tax payable for the period, and then you can deduct the amount of any withholding taxes already paid in advance that is on account. So there are so many payments that are not final, and you need to know these as well. So let's come to the tax compliance side of things. We are saying that after withholding agents withholds, they are required to pay to the Commissioner General within 15 days after the end of each calendar month the amount that has been withheld. After the same 15 days, they are required to withhold or file a return with the Commissioner General. That shows a number of things. It should show the payments made by the agent during the period that are subject to withholding. It should show the name, the address, and the tax identification number of the person they withheld on. It should show the amount of tax withheld from each payment and any other information the Commissioner may prescribe. This is generally found on the withholding tax return. We are saying a withholding agent who fails to withhold tax in accordance with the law is required to pay the tax that should have been withheld in the same manner and at the same time as tax that is withheld. It means if you fail in your obligation to withhold, then you will have to pay the tax in the same manner. So don't say, well, it is not my income tax liability that is being paid in advance. I'm only helping the state collect taxes. So instead of withholding on company B, I won't withhold. The law is saying that whether or not you withhold, you are still required to account for the withholding tax by the 15th day of the next month, whether or not you actually withheld, just like someone who withheld. So remember that the takeaway point is withholding tax for compliance purposes, you are required to 15 days after the month has ended, pay the tax you withheld and file a return with the Ghana Revenue Authority. So if you withhold on transactions made in January, then we expect that by before or on or before the 15th day of February, you file a return with the GRA and you pay the relevant taxes. It's very important to remember this. Then a statement and payment of tax withheld or treated as withheld. Let's look at this as well. We are saying that withholding agents who withhold tax under the Income Tax Act and pays that tax to the GRA or the Commissioner General is treated as having paid the tax or the amount withheld to the withholdee for the purpose of any claim by the withholdee for payment of the amount withheld. What does this mean? If a withholding agent rightly withholds tax and pays it to the GRA, he is treated as having paid the amount withheld to the withholdee for the purpose of any claim by the withholdee. So we are saying that someone actually withholds tax and makes payment of that withholding to the Commissioner General or to GRA rightly, then you, the withholdee, are entitled to a claim that indeed that amount has been withheld and you are entitled to any credits that may come with that amount. Also, withholding agent who fails to withhold tax under the Income Tax Act, let's say you fail to do it, but pays the tax that should have been withheld to Commissioner General in accordance with the law, is entitled to recover an equal amount from the withholdee. So this is a different scenario. Here is the case: you did not withhold when you were paying the other person, but you did the right thing by actually paying the right amount to the GRA. Let's assume you were entering into a contract with someone and you're required to withhold 500 cedis. You did not withhold the 500 cedis from the person. You paid the person the full amount. But you then went to actually pay 500 cedis to the GRA. The law is saying that you are required or you are entitled to go to the withholdee and recover the tax that you should have withheld from them. That is your own legal dispute to settle later. But we are saying that once you rightly account to the GRA, you are entitled to recover the amount from the person who you should have withheld on anyways. Then once again, we are saying an agreement, or except where an agreement is ratified by Parliament, a provision in an agreement which prohibits deduction of withholding tax shall be void. What we are saying is that, people can draft contract in so many funny ways. They can insert into the contract that this contract is not, or you shall not withhold under payment made under this contract. We are saying here that unless the Parliament of the Republic of Ghana has ratified an agreement that gives you the power or that exempts you from withholding tax, you cannot sit somewhere and draft a contract and say that, well, I don't want any withholding. So there are many businesses that deal on a don't withhold on me basis. So they are like, you know what, I'm entering into a contract with you, don't withhold on me, pay me the gross amount. What needs to be done is, whatever be the case, the right amount of taxes would have to be withheld and paid to the GRA. So what many people do in practice would be to find, or they will need to work back and then determine the amount that would have included withholding taxes, agree on that amount, pay the withholding tax to GRA so that the person they are dealing with will still get their money. So let's say the person tells you, I don't care about the laws in your country, no matter what, I want to receive 1,000 cedis and $1,000 as my contract amount. You can agree with them to work in such a way that your contract price you guys agree on will be worked backwards to determine an amount that will include withholding tax. You pay the relevant withholding tax to GRA and then they get to receive the entire 1,000. Key takeaway point from here is that you cannot on your own say that you are exempt from withholding tax just because you sat somewhere and drafted a contract that said you don't want this contract to be withheld on. It's very important to remember this. Then I spoke about withholding certificates. I'm saying a withholding agent is required to prepare and serve on a withholdee, that's someone they've withheld on, a withholding certificate in a prescribed form, which shall be delivered to that person. Then the certificate is required, or it will specify the amount of payments made to the withholdee and any taxes withheld by the withholding agent. This is something that is not being done in practice. What do I mean? The law says over here that the withholding agent is required to prepare and serve on the person the certificate. But I don't know whether it's good news or bad news. The Ghana Revenue Authority is the one that currently prepares withholding credit certificates. What do I mean? If Company A enters into contract with Company B and Company A is making payments to Company B for services rendered by Company B to Company A, what the law says is Company B should withhold on Company A should withhold on Company B, and then Company A should serve Company B with a withholding certificate. That's what the law says. But in practice, what happens is after company A withholds on company B, and company A files their withholding tax return with the GRA. Remember, I said it's 15 days after the end of the month. After company A files our returns and pays the taxes, then GRA will prepare the certificates and issue them to company A for company A to deliver the certificates to company B. So take note, this is what is done in practice. The law says the withholding should prepare, or the withholding agent should prepare and serve the certificate, but in practice, it is the GRA that does the withholding, that does the preparation of the certificate and delivers to the withholding agent for the withholding agents to deliver to the withholdee. Looks like this will change very soon as the GRA begins to go computerized or go paperless, go digitized. We are expecting a lot more innovation around technology, so maybe we'll not even need certificates anymore. They may be digital, your accounts may be credited in the back end, how much has been withheld based on your tax identification number. But as it stands now, the practice is quite different from what the law says. So this is something you should know. I'm still on this. We are saying a withholding certificate shall cover a calendar month and shall be served on the withholdee within 30 days after the end of the month. So the law requires that you serve the certificate on the person withheld on within 30 days after the month has ended. Once again, in practice, it's not easy to meet this 30 days deadline. And by the time you file a return and begin to follow up or chase for the certificate, 30 days would have passed. So it's not too realistic to get the certificate right on time to deliver to the withholdee within 30 days. So in practice, it's different from what the law is saying here. We are saying that where it comes to an employer, remember I said employers paying salaries or employment income to their employees would still have to withhold, just as a slightly modified system of withholding. We are saying that the employer is also required to issue to the employee a withholding certificate. That certificate is required to be served on the employee by the 30th day of January after the year has ended. That is where the employee worked with the employer for the whole year, or where the employee ended the employment or they ceased the employment before the year ended, not more than 30 days after the employment ceased. Now, a question I want to ask you watching this, if you are an employee or you are working, you're not a student, when was the last time your employer gave you a withholding certificate on the 30th of January after the year ended? If you've ever received this, just type something in the comments to indicate this. Or let's say where you left a job, you left your employer. Did you receive a certificate 30 days after you left your employer? Let us know in the comments. Let's see what the practice really is out there. So that's it. For employers, they are required or they have an obligation to also issue certificates to employees who have stayed with them for the whole year or worked with them for the whole year on 30th of January. So for the year 2020, where an employee has worked with an employer, by the 30th of January 2021, the employer will be required to issue the withholding certificates to the employee. It's just like a record of all taxes I've withheld on you and paid to the GRA on your behalf. That's what it means generally. Same for the employee who left the employment within the year. 30 days after you leave or after you cease employment with that particular employer, you're supposed to issue to you a certificate that you are supposed to carry forward to your new employer for them to continue withholding on. But I don't know. It's not too widespread in practice. Just take note of that. Then I've already explained what the final withholding payment is. A payment that fully satisfies your income tax liability. End of story. Now let's look at some examples of what the law says actually are final withholding payments. So we are coming gradually to what the law says a final withholding payment. So dividends paid by a resident company, final withholding. I've already mentioned this like a million times. Then rent paid to a resident individual under a lease of land or building, with or without associated fixtures and fittings, situate in the country, other than rent received by an individual in conducting a business. So if you pay rent to a resident individual and it is not an individual conducting a business of sale or letting, then that rent payment is a final withholding payment. After you withhold, it ends there, right? And generally, when it comes to rent, just know that there are two main withholding rates. If you make a payment for rent, there's a separate rate for when it is a residential property and a separate rate for when it's a non-residential property, when it's a commercial property. We'll look at all of that when we get there. The next is also rent other than rent, which is received in conducting a business of sale or letting, paid to a person other than an individual. So here too, if you pay rent and it's not rent in the conduct of a business of sale or letting, then it's also a final withholding tax. Then also payments made to non-resident persons that are subject to withholding under the Income Tax Act are all final, unless clearly mentioned. So you generally find out that most withholding payments to non-residents, if not all, are final withholding taxes. So you pay dividend to a non-resident person, 8% final. But don't forget that for non-residents, it's important to ask yourself, does Ghana have a double taxation agreement with the country of the non-resident person? If yes, check if the double taxation agreement provides a lower or reduced rate, in which case you would apply the lower or reduced rate. Also, when you're making payments to a person other than payments made in conducting a business or to exempt amounts, then you also need to consider these to be final amounts. Also, payments, like I said earlier, for examiners, invigilators, supervisors of examination, part-time teachers, part-time lecturers, the law also makes that clearly final withholding payments. Then, they're saying the following satisfy a person's liability for withholding under Section 1B, right? If you remember this, what we said was when we're treating the income tax basics, we looked at something called imposition of tax. We said tax was imposed at two levels. The first level was at the level of what? Chargeable income, and the level of final withholding payments. We are saying that where you withhold tax and it's a final tax, it satisfies the person's tax liability under Section 1B, which we saw in our first video. Yeah, so these are things you need to remember. Just know the concept of final withholding payment. It's a very crucial concept, a very crucial thing to remember. Let's look at credit for non-final withholding tax. Remember I said we have final withholding taxes which fully satisfy a person's tax liability. Let's come to the ones that are not final, or what some people refer to as taxes on account, right? We are saying a withholdee of a payment which is not a final withholding payment is treated as having paid a tax withheld from the payment under the Income Tax Act, or with respect to the person who failed to withhold tax and then the person should have paid a GRA, the person is treated as having actually paid or withheld or had the right withholding done on him, and they are entitled to a tax credit in an amount that is equal to the tax treated as paid. So like I said, remember I said for amounts that are subject to a non-final withholding, like goods, works, and services to non-resident persons, to resident persons, what the law says is you are entitled to a tax credit, and that tax credit will be used to reduce your income tax liability for the period. So when someone issues a certificate to you for a withholding payment that is non-final, the law says that you will have a credit that can be used to reduce your overall tax liability. And the question is why? It's only because that payment was not final, you included that amount, the whole amount, in your income for determining your chargeable income for the period. So it's only fair that any taxes that have already been paid on that amount will be given to you as a credit to reduce your tax burden for the period. Now let's look into details at the rates. Very important here. So these are the rates of withholding tax to resident persons to bring everything together neatly. Right? So when you pay dividends to a resident person, you withhold at a rate of 8%. When you pay interest, remember it excludes individuals and resident financial institutions. You withhold at 8%. Those who watch the income tax basic principles video, I think the third in the series, we looked at exempt amount and we said interest paid to a resident individual by a resident financial institution was exempt from income tax, which is why your bank doesn't withhold when they pay you interest on your savings account or interest on your fixed deposit because of that exemption. Right? But apart from those exemptions, interest must be withheld on at 8%. Then remember, I just mentioned rent on residential and non-residential properties. Residential properties generally withholding tax rate is 8%, and if it's a commercial property, you withhold at 15%. When you make a payment for natural resource and royalties, or royalties, you withhold at a rate of 15%. Where you make payments for fees or allowances to a resident director, manager, trustee, or board member of a company or trust, you withhold at 20%. Where you make payment to an examiner, an invigilator, a supervisor of an examination, a part-time teacher, part-time lecturer, you withhold at 10%. Remember, this is final. When you make a payment for endorsement fee, you withhold at 10%. Where you make a payment or a commission payment to a resident lotto receiver or agent, also 10%. Commission to a sales agent, 10%. Commission to a resident insurance sales or canvassing agent, 10%. Just remember that generally commissions are subject to a 10% withholding tax. Where you pay insurance premium with a source in Ghana to a non-resident person, the withholding tax rate is 5%. Remember I told you that where you pay insurance premium to a resident insurance company, you do not withhold on that amount, or the amount is exempt from withholding tax. But if you make payments to a non-resident insurance company, then you withhold at 5%. Then you remember the 2,000 cedis threshold for goods, works, and services, where you make enter into a contract for the supply or use of goods, and the contract amount exceeds 2,000 cedis, you withhold at 3%. For works that exceed 2,000 cedis, 5%. For services that exceed 2,000 cedis, 7.5%. Where you make payments for unprocessed precious minerals, you withhold at 3%, similar to the rate for goods. Where you make a payment to a petroleum subcontractor, you withhold at 7.5%. Then let's look at the rates for payments you make to non-resident persons. So we are saying when you look at employment income, so if you watch our series on employment income taxation, we said that non-resident individuals were subject to an income tax rate of 25%. Technically, that amount is satisfied by way of withholding because it's the employer who will withhold from the employee. If you remember also in that same video, we said that non-resident sportsmen, entertainers who came to Ghana to do any of their shows, even footballers, boxers, and all of those people, we said the law deems them to be employees of the company that brought them to Ghana. So let's say if it's a music event with Davido and whoever, Charterhouse or whoever brought them to Ghana will be deemed to be the employer, and Charterhouse will be required to make payment to Davido when they are paying him his appearance fee or whatever amount he was entitled to perform in Ghana, and he'll be deemed to be a non-resident employee, and this 25% rate will apply. It's a withholding mechanism if you think about it really. The next is management, consulting, and technical service fees, 20% withholding tax, non-resident. Dividends to a non-resident person is also 8%. But remember, all these things are subject to the existence of a double taxation agreement between Ghana and that country. So there are some instances where even dividend, you may have to withhold at a lower rate of, say, even 7%, depending on the agreement in a double taxation agreement. So in general, before we get to international tax, the topic of international tax, remember that where a double taxation agreement exists and it provides a lower rate, you are at liberty to pick the lower rate in the double taxation agreement instead of what the law prescribes. Once again, if the double taxation agreement provides a higher rate, which actually is the case for some double tax agreements, as usual, you are at liberty to use what the local Ghana laws say, because everybody's trying to pay the least amount of taxes possible. So remember that dividend is 8%, but remember to ask yourself, the country of residence of the person I'm paying to, does Ghana have a double tax agreement with them? If yes, then check the particular rate in that double tax agreement before you withhold. It may be lower than 8%. Also, royalties, natural resource payments, and rent to non-residents at 15% withholding, endorsement fees 20%, branch profit taxes that are repatriated 8%. We'll look at that when we do business and company income. Then interest income also at 8%, similar to that for resident persons. Then back to this insurance premium again. Remember, I said if the insurance premium is paid to a non-resident insurance company, you withhold at 5%. Then payments to petroleum subcontractors will be at 15%. Remember, the rate for resident persons is 7.5, non-resident 15%. Then supply of goods, works, or services where the contract gives rise to income in Ghana will be at 20% for a non-resident person. Remember, the resident person rates are 3% for goods, 5% for works, 7.5% for services, respectively. Then payments to a person who conducts a relevant transport business, 15%, and payments received by a person who conducts a telecom business, also 15%. So this will bring us to the end of the session on withholding taxes. The next thing we'll look at is, the next time we visit withholding taxes will be to look at examination questions, look at the number of scenarios and how examiners will probably phrase the exam question to test the key principles and concepts covered by withholding taxes. So as usual, if you love this, please smash the like button and don't forget to share this video within your network. I'll catch you in the next video.